I'm talking today with John Ditchfield. John is a wealth management advisor and head of responsible investments at Helm Godfrey. Welcome, John.
Good morning, Graham.
Good morning, John. John, tell me first a bit about your background and how you first got involved with ethically orientated investments.
Okay, so to begin then, I was first involved in this area back in the late 1990s with a firm called Barchester Green Investment. Barchester were probably the first ethical investment specialist firm set up in the mid 1980s, actually. I joined them because I was particularly interested in the area of environmental investment, which I saw to be an emerging area. So I was with them for a good 10 years or so, and I eventually became one of the owners of the firm and helped grow the firm to become one of the largest of the ethical investment specialist firms in the UK.
And without getting into the whole climate change debate, although indeed we probably may well cover this in a future webinar, why do you consider this subject so important?
Well, I mean, has there ever been a situation or an event which has deeper, more wide-ranging ramifications for humanity as a whole, really? The scientific evidence overwhelmingly shows or demonstrates that the threat posed by uncontrolled climate change as a result of greenhouse gas emissions and the changes we're making to the environment and the atmosphere around us could have extraordinary, deeply far-reaching and severely negative impacts for humanity. To say a bit more about that, I mean, the Paris Agreement, which is probably the most widely known example of the Conference of the Parties, broadly known as COP, brought together over 150 countries that were prepared to agree to attempt to try and cap CO2 emissions. So what you have there is, well, firstly, overwhelming scientific evidence that this is a serious and severe threat to the prosperity of humanity. And then secondly, you have almost complete, with some notable exceptions, acceptance of the need to reduce CO2 emissions and the emissions of other greenhouse gases. So as a result, I would struggle to think of an issue which has more broad and deep ramifications for investment markets than this issue.
Brilliant, thanks, John. There are a great many different terms which are linked with ethical investing. Are you able to demystify some of these terms and obviously explain why there is so much confusion?
No, I completely agree. I think it's an industry which hasn't helped itself a great deal through the proliferation of such a wide range of acronyms, abbreviations, and, as you say, terms. So probably to give some historical perspective might be useful. So what I'm thinking of there would be ethical investing, which is probably the oldest form of responsible investing. And ethical investing goes back several hundred years, in fact, to the Quaker movement in the UK, where the Quakers believed that those who practice Quakerism should avoid investing into, for example, alcohol or tobacco. So ethical investing grew out often of a religious or philosophical orientation towards a particular type of behavior. So it was very much about avoidance and not doing certain things. That led to the creation in the 1980s of the first screen funds. So these were funds which would hold a portfolio of companies which would avoid certain areas. Typically that might be tobacco, alcohol, munitions, so contentious sectors where individuals perhaps with a church background would seek to invest but without exposure to those areas. Moving on a little bit from that, so into the 1990s, the early 2000s, you then saw the arrival of sustainability funds. These were prompted by a major report which was issued by it's actually the Prime Minister of Norway that's often credited with this report, called Our Common Future, And what that report looked at was the potential risks to humanity arising from the damage we were causing to our natural environment. What this report pointed out was that we were causing irreparable harm to areas such as species, biodiversity, access to water resources, and our environmental wealth. And therefore, as a result, future generations may have poorer standard of living as a consequence of the activities of the present generation. So out of that came this concept of sustainability. And we then saw the rise of green, environmental, and sustainable funds. So these were funds that were seeking to invest into companies that were addressing some of these challenges, challenges around how we produce energy, how we utilize natural resources, how we produce goods and produce services, and trying to do those things in ways which have less of a negative impact for people and the planet. And there was a whole host of new concepts arriving into business theory. So the triple bottom line, concepts around ESG and the integration of environmental, social, and governance analysis into investment markets. And a lot of that was happening through the 2000s. Now, bringing things up to date, in the last 5 years, we've seen the growth of what's known as impact investing. So impact investing sits at the opposite end of the continuum from conventional investment funds, and an impact investment fund will seek to have very clear, measurable social or environmental consequences. So it's an attempt to try and say that a particular investment has clear, measurable, positive social and environmental impact. So I would say that's a reasonable summary of the history of the area of investment that I've specialized in, responsible investing, which I see as the general term, going from the early days of ethical investing through the emergence of a growing environmental sector, and as a consequence, environmental investing. You often saw this term SRI as well, socially responsible investing, during that period, up to today, where you have impact investing. And all those forms of responsible investment continue to this day. And as a result, we have well over 150 investment funds in the UK which follow those different types of approaches, leading to something I would certainly agree with you is quite a confusing and complex picture for a private investor who simply wants to invest in a way which is more closely aligned with their values, or perhaps simply sees this as a solid, how do you say, financial stance to take, that we're going to see huge quantities of capital moving into environmental solutions over the next 10 years or so. And so it's a sensible approach for an investor to take to seek to align their portfolios to some extent with that shift of capital.
Thanks, John. It is often suggested that by investing in ethical or responsible funds, an investor has to compromise on investment returns. Do you believe this to be the case?
Okay, so this argument was probably strongest in the 80s and early 90s, where you had a very limited range of investment funds that operated with negative screens, and where the predominant form of responsible investing was negatively screened investing, because it is true to say that in those funds, you didn't have a large environmental services sector. So you didn't have those types of opportunities. Renewable energy hadn't started to grow in the way it has over the last 10 years or so. So an ethical investment fund manager had fewer choices, and therefore it would have been reasonable to expect more volatility from the portfolios because they're investing into smaller companies, and perhaps impaired returns through certain periods within the market, through the market cycle. Now, I would really strongly dispute that and say that most of the research evidence produced by academic institutions or other independent reviewers of the sector are actually pointing to strong performance from some of the sustainability funds that are available, that ESG integration is now viewed as a mainstream investment practice which produces better outcomes for investors. So I would really want to argue that the The opposite is now true, that you're actually seeing strong performance from sustainability funds, and that more and more these types of strategies are becoming a core part of investor portfolios. And looking at the last 18 months or so, we've seen extraordinary volatility from oil stocks. So that's had a negative impact on conventional portfolios, which often have significant weightings to those types of companies. And we've also seen companies demonstrating particular resilience during the COVID-19 crisis. So I'm thinking there of a number of funds which are invested in the sort of primary services, so that such as environmental services and healthcare services, which have actually done rather well through this period, whereas many conventional funds would have weightings towards the sort of consumer cyclical stocks. So those are consumer stocks which are more sensitive to discretionary expenses and are therefore negatively impacted by this downturn in the economy. So what I've been seeing is good performance from the types of funds that we focus on in the responsible investment division, and we've certainly not seen a negative consequence for investors who've chosen to pursue this particular route.
That's great, John. It's good to know. Helm obviously now has its own responsible investment model portfolios that are available to clients, but there must be some of your clients who feel that their money is invested, or the way their money is invested overrides the importance of clear financial goals. How do you advise those clients?
Well, all financial planners have an obligation to ensure that the client's financial objectives are met, and that is of paramount importance. It would only be where the client is able to state categorically that they're prepared to allow their ethical or moral concerns to override their financial objectives that there would be any conflict. That is increasingly, that is less of a problem, simply because of the range of sustainability funds that are available. So, as I said, 10 to 15 years ago, it was difficult to build a full, what we call asset allocation mix for an ethical or responsible investment portfolio, because there may not have been funds available in certain sectors. So in Japanese equities or emerging market equities or high yield bonds or other sectors where there is little coverage from a responsible investment perspective. So I think what we're seeing now is the opportunity there is a good one for mainstream investors who perhaps want to have some exposure to responsible investment themes and can now access those themes through a very broad range of investment funds with good track record and other performance characteristics.
John, many thanks. I'm sure this is a subject that we will come back to at future webinars. Just a reminder that as everything we do at Helm Godfrey, it's important that we understand your circumstances, needs and objectives. All of the Helm Godfrey advisors are able to discuss how responsible investments fit in with your own situation. It is essential that you always do take advice.